The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Understanding Net Unrealized Appreciation. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you, Amber. Hello, everyone. Thank you for joining us for our webinar today on Net Unrealized Appreciation, or NUA for short. Before we get into the meat of today's webinar, let's decide, as we normally do, what our new webinar is going to be in April. Before I do that, let me tease for our March webinar. We're going to talk about the big changes to Social Security that happened recently. If you'd like to join us for that, it'll be, as always, on the first Wednesday of the month in March. That'll be March 5th, and as always at 11 a.m. Central. If you know of someone who will benefit from hearing what we have to say about the big changes to Social Security, feel welcome to pass along our information. They are welcome to join us on the webinar on Wednesday, March 5th. So let's go ahead and vote for April's topic. We've got three choices, the first one of which is kind of timely, dealing with 1099 forms, the questions our clients ask us about those. The second choice is life and annuity unanswered tax questions, and the third choice will be fighting with the IRS. I'm going to go ahead and open the poll and give you the opportunity to vote on April's topic. Go ahead and take a minute, and let's vote on April's topic. I'm going to go ahead and close the poll because I see that everyone has voted, and the topic for April will be life and annuity unanswered tax questions. Thank you for that. So let's go ahead and deal with today's topic, which is understanding net unrealized appreciation, or NUA. I will use the acronym NUA quite a bit, so forgive me for that. Understand that NUA stands for net unrealized appreciation. We're going to go take a quick overview of how NUA works. We'll give an example of the mechanics and the tax result associated with exercising NUA. We'll go over a few of the technical details that apply to NUA transactions. We'll identify the best fits for the clients who are the best fits for deciding to exercise NUA. And we'll conclude with a few concluding thoughts. So let's go ahead and give a quick overview of how NUA works. Essentially, NUA is a concept that hinges on the tension of recognizing an income tax liability now and weighing that against the possibility of a smaller income tax liability later. You know, it's one of the key concepts in ideas like Roth conversions, for example. The strategy is available when an employer-sponsored qualified plan owns qualifying company securities. And when I say qualifying company securities, it usually means stock in the company. And what kind of qualified plans are we talking about? Might be 401k plan, might be profit sharing plan, might be ESOP, all of which could potentially own securities, stock in the employer sponsoring the plan. The unrealized appreciation, the UA part of NUA, refers to the difference between what the plan itself paid for the securities and the current value of those securities at the time the distribution takes place. Why would somebody choose to do NUA? When it applies to company stock, it can help a client pay lower capital gains tax rates on a portion of the assets instead of paying typically higher ordinary income tax rates that would apply to a distribution from a qualified plan. So that's it. We're trying to capture capital gains rates instead of ordinary income rates. So let's go through an example of how NUA works, which I think is really the most effective way for understanding how it's used. So let's say that we've got Debbie, who's a participant in her 401k plan. And Debbie has chosen to use the money in her 401k account to buy employer stock over a period of many years. And so Debbie is going to retire this year at age 66, and her 401k account balance is worth $1 million. And it consists entirely, 100%, of employer stock, right? And the plan paid 400 grand in total for those shares during the course of her participation, paid different amounts over the course of her participation, but in the aggregate, they paid $400,000 inside the plan for the employer's stock. And so Debbie decides to exercise NUA. And so in order to do that, what she does is she asks the plan administrator, the 401k plan administrator, to send all of the 401k owned shares that are in her account to Debbie's non-qualified brokerage account. So the distribution is in kind of the company stock. And at the time of the distribution, Debbie has to pay ordinary income tax on the $400,000 of basis, the plan's basis in those shares, not the full $1 million. So she recognizes an immediate income tax result on the in-kind distribution, but the immediate income tax result is lower than the total value of the shares. Why would she do that? Why would she recognize an immediate income tax result instead of rolling over the $1 million to an IRA? Well, if she takes the distribution in kind, she'll pay capital gains tax on the difference between the $400,000 on which she recognizes the immediate income tax at her retirement and the sales price. So the capital gains rate under current rules, maximum of 20%, while top federal income tax rate, top rate is 37%. And in Debbie's case, the example doesn't tell us exactly, but in Debbie's case, the capital gains rates will be substantially lower than her projected ordinary income tax rates. Now, if Debbie had decided to roll over the $1 million, whether it's in shares or money, to an IRA, she would have lost the ability to take advantage of NUA. And so that's part of the tension that has to be sorted out when somebody has company-owned stock inside of a 401k plan or a profit sharing plan or an ESOP, and they have the option to take a distribution in kind. That's the tension. Should they exercise NUA, or should they simply roll over the entire amount that they're entitled to into an IRA. So that's what it is that that advisors have to help clients sort out. Now, there are some quirky rules in connection with exercising NUA. Uh, One of the quirky rules is this, and that is complete liquidation of the entire account is required in 1 calendar year following a distribution event. That rule tends to be kind of complicated because there might be multiple distribution events that somebody runs into. Here's an example. A plan might allow for complete access to money once the participant reaches age 59 and a half. So attaining age 59 and a half could be a distribution event. Once somebody does that, even if they're still in service, if they want to exercise NUA, they would have to completely liquidate the account in 1 calendar year following that attainment of age 59 and a half. In that same example, if somebody subsequently separated from service, right, after age 59 and a half, that would be another distribution event. And the door to exercising NUA could be open again if the plan owns company stock following that second uh, 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 distribution event. And the door to NUA, exercising NUA, could be opened again in another calendar year. So those things are kind of complicated. The details really matter, and understanding exactly when NUA might be available and what would be needed in order to exercise it correctly is a really important thing for those of us who work with clients who expect us to know these things. The second kind of quirky rule is that NUA persists even after the death of the account owner. So if somebody exercises NUA and doesn't sell the shares, um, uh, in Debbie's case, for example, if she exercised NUA, paid the $400,000 of income tax on the basis, and didn't sell the shares prior to her death, that $600,000 of gain, which is referred to as the NUA portion, does not get an adjustment in basis. If her heirs subsequently sell the shares, they still have to pay income tax on the $600,000 of gain. Now, if there's appreciation of the shares after Debbie's death, right, that portion can qualify for special treatment. But there is no step up in basis in NUA at death. The NUA portion always has to be recognized as a capital gains event once it's been exercised. There's no 3.8% Medicare surtax on the NUA portion if Debbie or her family end up selling the shares. And it is possible to pick and choose the shares for which NUA are being exercised. Here's what I mean. While the account has to be liquidated in just 1 calendar year, you don't have to exercise NUA with regard to all of the employer's stock that the plan owns. You can sell just some of it. And if you can pick shares with a low basis to exercise NUA to minimize the income tax result now and maximize the amount of gain that can be deferred later. So picking and choosing the shares for NUA treatment is possible as long as the account is completely liquidated in 1 calendar year. Who are the best fits for exercising NUA? Well, I think first of all, if you've got somebody younger than 59 and a half who's separated from service, who's thinking about this, you want to remind them if they exercise NUA, they're going to have to pay the extra 10% penalty tax on the basis portion that's being of the shares that are being distributed. And so the best fit is somebody who's already attained age 59 and a half and doesn't have to worry about that. Another good fit for NUA is somebody who believes that their future income tax rates are going to be higher than the rates are now. It's going to be somebody for whom complete liquidation of the account makes sense. There are circumstances where complete liquidation might be problematic because you're trying to manage other issues. So you want a candidate where complete liquidation in 1 calendar year of the account makes a lot of sense. Another key consideration is that the stock that's owned by the plan is worth a lot more than the plan paid for it. You want to make sure that the amount of money that's going to be saved potentially by exercising NUA is going to be big enough to make it worth the hassle, not only of paying income tax early, but also the psychological or administrative hassle of actually exercising NUA. And then, it makes a lot of sense if somebody's going to be needing funds immediately. They can use the NUA strategy and sell the securities pretty much right after transferring the securities to their brokerage account and get long-term capital gains treatment. There is no additional holding period. And so you can transform money that might otherwise be taxed at 37% if it were distributed immediately. By going through the NUA process, you can get it taxed at 20% instead. And so in those circumstances, it makes sense for somebody to continue exercising the NUA process. So what are the conclusions that I hope you draw from this? Well, first one is that NUA is deceptively simple. And the idea of it is pretty easy to explain at a high level. You're trading an immediate income tax result for the likelihood of lower taxes later. The technical nuances of NUA are important to be considered. You got to do it right procedurally. You got to liquidate the account within 1 year after a triggering event. And so that needs to be thought about, because if you screw up, there's no way to fix it. And then the best fit really is somebody who's got significant, highly appreciated company stock positions inside of the employer-sponsored account. I'd like to thank you again for being with us today, and I'm going to turn the program back over to Amber to close this out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, March 5th, at this same time. Next month's webinar will be titled Big Changes to Social Security. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.